Good morning. Today, I've got one easy tip to help you save $10,000 in investment returns. I know that sounds like a lot of money, and it is actually a relatively easy tip. This is looking at the expense ratio of the mutual fund or the exchange traded fund that you are invested in. The expense ratio is the amount of money that's charged in order for a fund manager to essentially manage the portfolio of securities in the investment fund that you're invested in. And this is measured in what's known as basis points. So if you think about it from the standpoint of a percentage of the total amount of money that you invest, an expense ratio is a fee for that money. So for instance, if you are paying what is known as 10 basis points, right? That's 1/10 of 1%. 100 basis points is 1%. But if you're paying, say, 10 basis points, and that's 1/10 of 1%, that means for every $1,000 that you invest, every year you're going to pay $1 as a fee to the fund manager in order to maintain the investments. And this is used just for the administrative costs of the fund. When you're looking at index funds, there are many different ways that you can invest. And for those that are not super experienced with investing, I do recommend that they have a large portion of their investments in index funds. And index funds track the indexes that are established by boards of companies or institutions that identify broad numbers of stocks that reflect the broader economy and that are a good cross section of the broader economy. Now, remember, you're still owning businesses. You're not owning the economy. You're still owning businesses. So it's good to keep that in mind when you invest. There's risk involved. But an index is a broad base of many different companies and gives you plenty of diversification. And the reason why I recommend them is because for those that aren't as experienced in investing, I would recommend that you pursue these because you're going to get your fair share of market returns. Now, for those that are a little bit more experienced and they want to take some more risk, they can put their money in actively managed funds. These funds are going to be more expensive. The expense ratios are much higher. However, there is the possibility that they could produce a higher return. So I'm not trying to tell you that the expense ratio is the only thing you should look at. What I'm recommending is if you're investing in broad-based index funds, compare the expense ratios of the two. For those that are invested in 401ks, 403bs, for active duty military, who are watching, or veterans, maybe who have already gotten out, you may have money in the Thrift Savings Plan, the TSP. This is your employer sponsored retirement plan. If you look at the expense ratios in these, some of them may be higher. Now, the TSP has very low expense ratios. However, there are some 401ks that have funds that are higher. When you're looking at investing, what you want to do is you first look at, again, expense ratios isn't the only thing you're looking at. You may want to put your money in a 401k first, especially if you're getting matching money, because that matching money is free money. And I would much rather you capture the match than try to avoid a higher expense ratio. So first you want to make sure you do that. But if you're looking at your 401k, or if you're looking at your TSP and you're going to compare it to other funds that are almost identical to it, the expense ratio can save you a lot of money. I'll give you an example. If I'm looking at, for instance, a mutual fund, let's say it's with, say, Prudential or USAA. Again, I'm not endorsing these companies. I'm not actually using an example from them. I'm just saying if you're looking at a company outside where you normally invest, and let's say the expense ratio, is 0.25% or 0.5%. It's not uncommon. And then in the TSP, you have something that's 0.05%, or in your 401k, you have something equivalent to that. That's a large delta, right? That's almost 0.5% that they're charging for the money you've invested every year. So if you imagine 0.5%, let's say over 30 years, you saved $500,000 towards your retirement. 0.5% of that every single year, that's going to be a lot more than $10,000. And so if you keep that in mind, if you're looking at that expense ratio and you're aware of how high that rate is, it's going to help you a little bit better to save money, because that is not only going to save you money, but it's also going to have the effect of more powerful compounding faster. Because that's one of the magics of compounding is when you earn interest or you earn a return, it builds on itself year over year. But on the flip side, that's the problem with the tyranny of compounding costs. If I have a very high expense ratio, that's taking money, it's kind of skimming money off the top of my investments every year, and the compounding is much slower. So we want to, again, we're comparing apples to apples here. If you're looking at two index funds that are the same, you definitely look at that expense ratio because we want to get you to your goal of financial freedom as soon as possible. Please post a question or comment. Send me a private message if you want to talk about it privately. I always enjoy reading your comments. And until next time, I wish you unlimited success.